Hi, my name is Alex Johnson, and this is the Fintech Takes podcast, the place where I workshop new takes, talk with fintech friends, both old and new, and explore the less trodden spaces in our well-trodden industry. Hello, and welcome back to Fintech Recap. My name is Alex Johnson. I am the creator of the Fintech Takes newsletter, and joining me, as always, is my friend and the publisher of Fintech Business Weekly, Jason Mikula. Jason, how are you?
I am doing pretty well. It's solidly fall here in the Netherlands, which I have to say I'm pretty happy about. Coming back here after about 10 days in Guadalajara, where it was quite hot. I'm pretty happy to be home.
Yeah, I would imagine that's a bit of not only a changeover from a time zone perspective, but also like everything weather related is just like opposite, I would imagine.
Weather related, food related, language related, just yes, opposites all around.
Well, if you don't follow Jason on Twitter, I don't know why you wouldn't, but he does a wonderful food not fintech hashtag for whenever he visits Mexico and is eating delicious food. So if you need recommendations or are just sort of looking for an Instagram like sort of FOMO experience of following along, every time he posts a meal, I get really jealous.
Yeah, it's my cholesterol's probably worse for the wear, but the chilaquiles were worth it.
Well, you know what? If you avoid these things, you won't live longer. It'll just feel like it. So, well done on that front.
Thank you.
Okay, well, we're gonna jump in, and as always, we're gonna bounce around a few topics that we saw from the last month or so. Before we do that, I will say that we are actually approaching at the end of this month, Jason and I's 1-year anniversary for doing this podcast, which we started by doing live from Money 2020 last year. And we are doing a reunion show live from Money 2020 this year. So we are on the schedule. We will be recording live. If you're at the event, you can actually come sit and watch us podcast live, which I think would be kind of a strange experience, but maybe it's something you'd be interested in. So please do that if you're around. And certainly Jason and I will be very busy and running around at Money 2020 and would love to see you in person as well.
Absolutely. So yeah, definitely say hi if you see us. And with that, should we get into the stories?
Yeah, you go first.
All right. I think any longtime listeners or readers will know that both Alex and I share a very special fascination with a neobank / lender called MoneyLion, which last week the CFPB brought a lawsuit against MoneyLion that hinged on two key areas. Number one was UDAP in the structure and practices of its membership program. Specifically, that MoneyLion advertised to users that they could quit the membership program for any reason, including specifying this in the user's contracts. But in reality, users were unable to exit the program, which, by the way, cost $19.99 per month until they had repaid their loans in full. And in many cases, even if they had repaid their loans, if they had any previously outstanding membership fees, MoneyLion would not let them end the membership, meaning they continued to accrue new fees. The sort of second bucket of allegations in the CFPB suit center around the Military Lending Act, the MLA, which is a somewhat like esoteric piece of legislation designed to protect members of the military from certain aspects of consumer credit, consumer finance. CFPB found that the interest and membership fee combined exceeded the 36% quote unquote military APR cap, which is a slightly different way of calculating APR, which we'll probably get into. That is a provision of the MLA, as well as a couple of other components around requiring mandatory arbitration and certain disclosures that are required by the MLA. Now, Alex, I'm sure that you saw this case. The suit made some interesting reading. Any initial reactions to the allegations that the CFPB detailed?
My takeaway was that this was utterly unsurprising. And you referenced the fact that you and I are both mildly obsessed with this company and have been for a while. I mean, I think anyone who's been paying attention to this company will not be terribly surprised by this, right? I think you actually outlined in a newsletter a while ago that MoneyLion was facing a number of different fronts from a regulatory scrutiny perspective, both on
it was like a year ago.
Yeah, exactly. So it's like, I mean, they had to disclose that. We'd known this is coming on a number of different fronts. There's probably more to come beyond just what the CFPB has sort of filed suit around. But no, I mean, I wasn't surprised at all. And I think even if you didn't know that the regulatory actions were sort of in progress, which obviously we did, again, even if you didn't know that, I wouldn't have been surprised, right? And you and I have talked about this before. I mean, one of the things that's interesting to me about fintech is there's fintech as a product and there's fintech as marketing. And learning to separate the two is really, really important, because from a marketing perspective, any consumer-facing fintech company is going to present their products in a certain light, right? They're going to say, banks are bad, they charge high fees, we're better, we do these things. They'll have a website that's nicely designed. They'll have a beautiful mobile app. They'll have fun logos, some of which I've ranked in my newsletter in the past. Actually, MoneyLion's logo did pretty well, strictly on a aesthetics perspective, not having anything to do with the company. And so like on a marketing front, I think a lot of times you can go, oh, wow, that looks like an interesting company. But if you sort of divorce the marketing from the product and you just look at the product and like, what are the terms? How does the product work? It can become fairly obvious that like, this is not a product that's going to disrupt banks. This isn't even a product that's going to really disrupt other like neobanks in the space. Like, this is a product that's aimed at disrupting other subprime lenders, right? And other banks that sort of are somewhat predatory in the way they work with low income consumers. And I think in this particular case, you know, whenever I look at kind of MoneyLion's lineup of products, you know, I see a very, very expensive, consumer unfriendly product design. And you reference the $19.99 a month that you have to pay to be a part of this sort of membership program. I was going back and looking at a Twitter thread that I put out about a year ago, actually, talking about MoneyLion's credit builder loan. And there was actually a page on their website. I'm not sure if it's still there or if they've changed it, but at the time, it was a page talking about why you should keep your membership active and continue paying $19.99 a month, even after you pay off your loan. And the reasons for that were that you could get access to credit monitoring tools, which for $19.99 a month, you would probably be better served spending your money elsewhere to do that. The ability to get access to more credit builder loans in the future, which I don't really understand why you'd have to pay $9.99 a month for that. 0% APR Instacash, and we haven't even talked about their Instacash product yet, though it may come up. And then my favorite one at the end was a monthly lion's share loyalty program payout of up to $19.99 per month. So in reality, what you would pay for $19.99 a month was the ability to get credit monitoring services and the ability perhaps to get a reward credit of up to $19.99 a month. So just like looking at the product and its product design, it never made a ton of sense. And I guess to go back to your original question, no, I wasn't terribly surprised by this.
There was some detail in the case that I actually admittedly did not know, which was there was a predecessor version of this product that charged, believe it or not, more. It charged $29.99 per month to access a loan of up to, I think it was up to $500 at 5.99%. And so putting my cynical hat on, and I think that MoneyLion has earned it, what it really looks like they've done is they've attempted to cobble together some, features and benefits that they could defend and say, this is a membership program, and what you're paying for are these attributes like the credit monitoring, although there's this site I've heard of called Credit Karma that does a pretty good job of that for free. So Moneyline's tried to cobble together a number of features so that they could make a defensible claim that this was a true membership program and the loan was just one component of that program. Why would they do that? Because if it's a membership fee, a bona fide, I never know how to say that, membership fee, it is not considered a finance charge under TILA Reg Z for typical consumers. And that seems to be why the CFPB brought this case as a Military Lending Act violation, because the MLA is very clear that participation fees explicitly are included in the military APR calculation, and the CFPB has jurisdiction to enforce that 36% APR cap. In regular world, non-military Lending Act world, the CFPB doesn't actually specifically have a cause of action based on interest rate alone. That would be a state usury issue. And so it's an easier case for the CFPB to bring under the MLA versus saying an average consumer was harmed by the structure of this program. There is a case you could make there, but it would be harder because you'd have to argue, this entire membership thing is a ruse and it's just disguising what is in fact a finance charge. So really, that really feels like what Moneyline was probably doing here. But, the nature of bringing a case, you want to marshal your best evidence and present it in the most straightforward way possible. And that seems to be what the CFPB did here by making this argument under the MLA. The UDAP component about basically making it very difficult for users to cancel their membership, that was for all consumers. That was not specific to those protected by the MLA, which is active duty service members and their dependents.
Well, and you had a funny analogy in your newsletter. Can you share that one that you used for the UDAP portion of it?
It's I feel like you had to be alive at a very specific time, I guess, in like the pre-streaming universe. But I think many of the listeners probably remember Columbia House. And I guess at some point, Columbia House and BMG, which both kind of ran similar mail order music subscription clubs, I think they merged. But basically, like the most notorious example I can remember of, luring folks into signing up for something that they may not have understood had a recurring component that if you did not opt out of, negative option billing is sort of like the technical term, that you would just keep receiving CDs or maybe vinyl or 8-tracks or tapes, depending on how old you are, in the mail until you reached them to cancel it. And so the sort of joke or comparison is that, Moneyline made it very difficult, if not impossible, if you had a loan outstanding, to get out of this very expensive membership program.
Hey, going back to the point you were making before, I mean, it's a really good observation about the way the CFPB approached this particular case and why sort of going through the Military Lending Act was a good way to sort of get at that core problem. But I think if you take a step back and you just look at this overall product structure, it absolutely makes no sense, right? Like no one is going to pay $19.99 a month to get access to take out a loan of, let's say, $1,000 that you have to pay interest on. And that, by the way, because it's a credit builder loan, you're not actually getting the money, right? You don't get the money. They present it as like forced savings, where at the end of the time, they release the funds to you as you pay it back. But like, it's not even a loan. You're not getting the funds from them as you're getting it. And so like it's like a Russian nesting doll of terrible product design choices, just layered one on top of the other on top of the other. And, we, I think, have been critical or sometimes questioning of other neobanks and their products in other areas, right? So like you look at like Chime or Varo, and I think you and I both have our critiques of those companies and concerns about their business model and sort of what their path is to move forward and continue to grow and to generate profitability. But, you look at like the credit builder card products that they offer. And again, I've been critical of those products and some of the sort of implications of how they're designed. However, they're incredibly consumer friendly products, right? They really are. Like they're incredibly low cost. They're incredibly safe to use. They're effective in helping people build their credit scores. They're really consumer-friendly products. This is not. This doesn't belong in the same universe of conversations as those products, because it's just, again, it's a number of different bad design choices layered on top of each other with, to your point about being somewhat cynical, some very clear choices that were made that seem designed more to limit their legal liability than to actually create value for customers.
I agree with that. I mean, the component that I was a little disappointed not to see in here was anything related to the Instacash, which is sort of the cash advance / payday loan like product, which is separate from the membership credit building loans that we've been discussing. Nothing in the case had anything to do with that product or the tipping, quote unquote, tipping and expedited funding.
Don't get me started on it. Don't get me started. I hate tipping.
We won't. We don't have enough time today, but I guess, I mean, I'm surprised that as far as I'm aware, there's been no cases out of the CFPB having to do with tipping. And this would have felt like a logical one to sort of go to. But I guess given that they had a really good fact pattern under MLA and UDAP, I guess maybe they didn't feel the need to open that can of worms, and neither will we today. Should we move on to our second story for today?
We should. Thanks for keeping me calm. I appreciate that. I was just about to jump off the deep end, but I will not. So we'll move on to our second topic, which is, speaking of the CFPB, we're going to talk a little bit about their report that came out on buy now, pay later. So as listeners will probably remember, a while ago, the CFPB basically put out a call for information asking for the industry to provide input and information into the research that they were going to do around the CFPB space. And the industry, all of the large buy now, pay later providers, all, from what I understand, were very cooperative. They participated in that process very actively. They provided data. And the resulting research report was just published by the CFPB. And if you haven't gotten a chance to read it, you should definitely read Jason's newsletter, because he writes a very good summary of what they sort of found. But to kind of hop through some of the specifics, I think in general, they definitely acknowledge some positives about buy now, pay later as a product category. And, overall, I found the tone of the report to be fairly positive. So I think in general, for fintech and for the buy now, pay later space, that was probably an overall positive. They talked about the fact that buy now, pay later has this kind of close-ended design where there's sort of a known total amount that you're borrowing and a sort of end in sight in terms of the total cost that you're going to pay. They talk about the benefits of it being sort of a simple product structure and having a simple UX, which you can contrast with credit cards that are sometimes a little tricky to figure out, like, hey, how much should I pay? What's the minimum payment? So they were very sort of complimentary, I think, of that. And then also the benefits of it being sort of widely available and being a more sort of accessible credit product for the masses than credit cards sometimes are. That said, it wouldn't be a report from the CFPB if they didn't also point out some of the potential risks associated with it. So they talked about the stacking of buy now, pay later loans by consumers. So getting a loan from Klarna, a loan from Affirm, a loan from Afterpay, maybe multiple loans from those providers, and stacking them up together in a way that might sort of be somewhat difficult for the consumer to keep track of, or even have an ability to understand what their total sort of amount owed is. Talked about sort of the underwriting and kind of credit scoring component to all of buy now, pay later. So obviously it's widely available in the industry, but it's also one that traditionally has not been furnished to the bureaus from a data perspective. And so it doesn't necessarily help you build your credit. What are some of the concerns for consumers around that? Also, as it relates to credit cards, it doesn't come with the same sort of consumer protections that credit cards are built in with. And so, again, if consumers are using it to shop online and are thinking of it in the same terms that they think of credit cards with, that's not necessarily true. They dinged the industry, I think, a bit on consistent consumer disclosures. And then there's this sort of broader concern, which I think under Chopra's, agency has been something they've looked at across the board, which is just the concern around data harvesting and sort of big tech making its way into financial services and using consumers' data in ways that are maybe inappropriate. Some concrete stats from the report, they found that 15.5% of users had 5 or more buy now, pay later loans during Q4 of 2021. So that kind of goes to that sort of stacking issue. 4% had 10 or more buy now, pay later loans, which is, even though 4% is a relatively small number, that's still kind of shocking to me. And then they found that overall, just from a market dynamic perspective, the margins that buy now, pay later providers are getting from merchants are starting to compress, which is something that I think we've all seen coming just based on the amount of competition in the space. And the fact that merchants, I think, are getting a little smarter about it. And then charge-offs on buy now, pay later loans are rising. And again, that's something we've seen some burblings of based on some data that's been shared. But the CFPB report, I think, makes it pretty clear that that's trending in a somewhat concerning direction. And as the sort of overall macro environment maybe worsens a bit, that's something that seems likely to continue. So, Jason, I know you read the report with a fine-tooth comb and obviously did a great summary of it. What were some of your big takeaways?
A lot of the sort of major business publication coverage positioned this as like consumer regulator imminently, regulating BNPL. And that isn't exactly what my takeaway here was. I mean, I do think that this market monitoring exercise potentially does lay the groundwork for either interpretive guidance, and or rulemaking. So I do think that is probably the direction things are going. But to the points you made in your summary and analysis, it's not like the tone was, overwhelmingly negative, right? This isn't the kind of language we've seen around things like quote unquote junk fees, which have taken aim at everything from overdrafts and NSFs to more recently credit card late fees. Like that is those topics are it's very clear where the Chopra CFPB stands on those topics. Here, it was like, okay, there are some positives around the structure of the product versus typical revolving credit cards. It's available. It's something that, perhaps is a good sort of on-ramp into the credit and banking system for younger consumers or thin no-file consumers. So they acknowledged the positives and then pointed out like, hey, these are the areas we're concerned about, some of which the BNPL providers and together with the credit bureaus are already working on. So that would be specifically the furnishing of data from BNPL providers to the bureaus, which then will potentially help address some of these other issues around stacking, using a bunch of BNPL plans at the same time, sustained use, underwriting ability to pay, and so forth. So I think, I interpret this more as like, this is a roadmap for the BNPLs that want to be on the right side or the safer side of the regulatory apparatus. Here's a roadmap of things that you can do to sort of start getting there. So I don't view this as like an overwhelmingly critical or negative critique of the product category or of the industry. I think for me, some of the more interesting things, and you cited some of these stats, prior to this report, really our main source of visibility into what was happening in this product segment was limited to companies that offer it that are publicly traded and file disclosures, or the European companies that tend to have stronger disclosure requirements, even if they're private. So for me, some of the components that were the most interesting were the specific stats around margin compression, which is driven not only from the merchant side that you mentioned in competition, but also as these companies continue to try to grow market share, increasingly they're doing that by offering BNPL financing outside of merchants that they contract with. So that is through things like the browser extensions, which I always find like kind of funny. I installed the Klarna one just to kind of like see how it works, as well as some of these either virtual or physical cards. So Klarna's doing one in the US. Affirm has been planning one, which is still not yet live, I think, called Affirm Plus or Affirm Debit Plus. So there is no agreement with a merchant that lets the user use BNPL at any merchant, but it also means the revenue that the provider is getting is just a standard interchange. It's not any sort of elevated rate based on a contract with a merchant. So I think there were some very interesting details about how the dynamics in the sector are evolving. But my read on it was not, overwhelmingly like CFPB is going to come and, regulate this product out of existence. I really don't think that's the case at all.
Overall, I mean, this probably isn't how the Bureau would put it, but like it seemed much like an endorsement of the product category and then concerns about how that category evolves over time, right? To your point, I mean, they definitely pointed out areas around, and we see this like from regulators in Europe too, right? Like concerns about affordability, concerns about how you're doing underwriting, how you're going to prevent consumers from sort of taking on more debt than they can afford. I think that the credit bureau, credit reporting one, which I've written about in my newsletter in the past, that's a really interesting area because I think from both a sort of consumer advocate perspective as well as just from the CFPB's perspective, I honestly don't know if buy now, pay later providers furnishing data to the bureaus is going to be a net positive for consumers or not. Like I really, I can't tell if it's going to be positive or negative. I think in general, it's probably a good thing for lenders and for the ecosystem to have access to that data and be able to factor it into their underwriting, but like not totally sure it's going to be a net positive for consumers. But I think those are the sort of like areas that the Bureau is looking at is this category exists. It should exist. It's largely a positive for consumers. But as it evolves, we want to make sure that we're sort of providing, as you said, some guidance, kind of a roadmap for where we'd like to see it move directionally and, highlighting areas where if you get on the wrong side of this, that may end up putting you in regulatory crosshairs down the road.
Yeah, I mean, I think that's exactly right. I mean, one last comment on this one, which, there's historical precedence around the creation of, if not inside the Bureau, sort of other databases to enforce rules about product usage. People who have had the luxury of working in the short-term lending space, certain states have a database called Veritech that is used to enforce rules around payday borrowing. So if there's a state law that says you can only have one loan at a time, every lender is required to report into that database, if somebody has used a loan and when they pay off that loan in order to ensure compliance with the state law. So it's not like there's no example of creating something to track a sort of novel loan category that isn't a credit card and is not a long-term installment loan. So, I mean, I'm confident they're very smart people at the bureaus. They're very smart people at these companies. I'm confident they will figure out the right way to incorporate this data. To your point, the outcome is not necessarily this is going to make your credit score go up. That's not even the right frame in my mind. That is sometimes how you hear some legislators or consumer advocates talk about it. But in my mind, that shouldn't be the goal. The goal should be having potential creditors have accurate data to understand, can this consumer afford or can this consumer not afford the credit that he or she is trying to take on? And that is a good thing for consumers because it should help protect them from becoming overly indebted. And it should be a good thing for lenders by helping them manage their credit risk and default rates better. Like the goal should not be make everyone have a 800 FICO score.
Right. I mean, by definition, the FICO score is designed to be a bit of a bell curve, right? I mean, like it's supposed to be a distribution of risk. Not everyone can have an 800 FICO score. So I think to your point, it's a great way of thinking about it that like one of the big concerns I have about buy now, pay later, and it seems like it's reflected in the CFPB's report as well, is it's just kind of a black hole right now in terms of what consumers are doing in there. And we really don't know much. And this report was one of the first ones to at least report out some data on performance, on margin compression, on some of those things. But to your point, a lot of these companies are still private, or they're only reporting certain data in their quarterly earnings reports. And we just don't have a real good granular view into the performance of these products. But the more of that gets shared, the more of it that gets reported back through the bureaus, I think the better idea we're going to have of the overall risks this presents to consumers. And I think the point you made, and then we can move on to the next one, is a really good one, which is that like, this is just a different product, right? And I think that was the thing I was most encouraged by from the CFPB's report overall, is that they seem to understand like, this is not an installment loan. This is not a credit card. This is something new. And we should evaluate that new thing on its merits and talk about what its sort of distinct advantages and disadvantages are. And, on the whole, I think the Bureau did that pretty well.
Should we move on?
Yeah, let's do the next one. We'll hit the next two fairly quickly, and then we'll end as we always do with a couple can't let it go topics. Really quickly, there was some reporting that happened a little while ago from CNBC and Bloomberg that basically talked about rising subprime losses for Goldman Sachs card program. So I think they reported that losses on the program had gotten up to almost 3%. And that the share of its card portfolio that is sub 660 FICO score, which puts it in that sort of subprime category, is over a quarter of the entire portfolio, over 25%. And, it's interesting. I know, Jason, you have a ton of thoughts on Goldman Sachs. So, try to keep your thoughts contained to a couple of points so we don't have a ton of time. But if anyone's interested in digging in more, definitely read Jason's newsletter because he talks about this stuff pretty consistently. The thing I'm sort of struck by with Goldman is they started with Apple Card, which obviously is the one that's sort of generating these losses initially. There's some reporting that they now have signed a deal perhaps with T-Mobile to offer a co-branded credit card. T-Mobile obviously isn't exactly a super prime set of consumers. I think most of their consumers actually skew somewhat subprime. And so it's interesting to me just from Goldman Sachs's perspective, I would have always assumed they would have stayed more towards the prime or super prime end of the market. But as you know very well, competing in the co-brand space, you kind of have to just go after the partners that you can get. And I definitely get the feel from Goldman that more than pursuing a very deliberate strategy, they're just kind of lurching from one potential partnership or avenue of growth to another and kind of eating the consequences of those decisions as they come. What's your reaction?
Yeah, I mean, I think that's right. So as far as the loss rate being almost 3%, and that is primarily driven by Apple Card. Goldman acquired the GM co-brand portfolio from Cap One, but it's quite small. I think it's like $2 billion out of the 12 or so billion in credit card receivables Goldman has outstanding. The argument that Goldman makes, and from talking with people who are smarter than I am, this, I think, holds some water, is that it's a young portfolio. So, I mean, the Apple Card is, I think, like 3 years old. And so card programs, when they're just getting started, have yet to, quote unquote, season. Meaning, if you look at the average tenure of a cardholder, by definition, it can only be as long as the program has been in existence. So if you look at a more steady state card issuer, they've sort of cycled through the bad customers who are going to default and charge off, and they have a larger pool of good customers that they have a long track record on. So that's sort of Goldman's response to this stat, which I think came out of their 10Q filing, that the charge-offs are high, subprime like. They're basically saying, yeah, it's because we're like, this is a new program, give it time, and that number is going to come down, which seems generally reasonable. The part that is a little bit more surprising is in the card program, something like 25% of the portfolio is sub 660. If you compare that to Goldman's own Marcus installment loan, only 5% of that portfolio is sub 660. Right. And my understanding is that this is basically driven by agreements, well, the agreement with Apple in the current case, as far as what that credit box looks like. So you and I both know that there's plenty of money to be made doing subprime credit cards. The reason it sort of turns into a news story is it's like, oh my gosh, Goldman, White Shoe Investment Bank is, slumming it doing subprime credit cards. It does make a good headline. It doesn't mean necessarily that they're not making money on the cards. The T-Mobile thing, I saw that headline and it just it kind of felt weird. Apple completely makes sense from this sort of like brand PR perspective. Like Goldman is, building a platform business. We're innovating. We partner with Apple. The GM thing also, frankly, to me felt weird of like, okay, what's the strategy here? And now you have T-Mobile. T-Mobile apparently is the second largest mobile phone company in the US after it merged with Sprint. But it does skew subprime, which was an intentional strategy on T-Mobile's part. And I looked at their 10Q filings, and something like 38% of their outstanding receivables are from subscribers that their own model, T-Mobile's model, says are subprime. So, okay, you have, almost 90 million people. That doesn't guarantee that a co-brand card is going to be successful. There are other examples of sort of mass market products. Uber is my favorite, which had a co-brand with Barclays. Just because you have a large base of people to market to does not mean it's going to be successful. There needs to be sort of a program design, rewards design that motivate people to sign up for it. Uber did not seem to do that successfully with Barclays. Apple had a huge built-in base of mega fans eager to sign up for everything. So yeah, to try to answer your specific question, I'm still not really clear what the strategy here is, other than like try to get any co-brand partner that's willing to have them.
I think you make a really good observation that like the problem in co-brand or partnership-based programs is you're sort of somewhat damned if you do, damned if you don't, right? So the damned if you do is, well, if you design a really good program that drives a lot of usage and consumers adopt it, well, then the merchant is going to want to have the credit box be as wide as possible because they want all of their consumers to participate in it so that it strengthens their core business. But then that creates a potential sort of underwriting loss mitigation problem for the lender. If you're damned if you don't, that's the Uber problem, which is, well, we signed up this big merchant, we did all the integrations, we built the platform, we got the program in place, but they never really cared about pushing it into the market. And, we're safe from a credit perspective, but we've never really cranked the growth at all. And we're not seeing any receivables or any transactions. And so it is this really strange business where you have to sort of end up in that Goldilocks zone where you're really active, you've created a good program, it's driving a lot of growth, but you're also aligned with the merchant so that you're not driving too much bad consumer activity through the program and driving losses to a point where it comes back on you. So striking that balance as a lender directly is hard enough. And to your point, you have to go through seasoning, you have to sort of learn the business over time. Doing that going through co-branded partners is an order of magnitude more difficult.
Mm-hmm. So Walmart is preparing to launch its quote unquote checking account. Now, people who've been following the story closely know that this isn't exactly new news. Walmart launched a sort of fintech venture that is majority owned by Walmart, but like it's kind of a separate thing. It was briefly called Hazel, and actually Ribbit Capital is also a minority investor shareholder in that project. That entity acquired a neobank called One Finance, which partners with Coastal Community on a sort of like classic debit card neobank product. It also acquired the earned wage access platform Even. I believe is Even Responsible Finance. There's more than one company called Even. And some of the narrative I've seen in the press is like, Wall Street, watch out, like Walmart's coming to banking. I'm kind of curious, Alex, your point of view, is this actually a threat to establishment banks? Your sort of Chase and Wells Fargo's of the world. I mean, what is Walmart's strategy here?
Walmart's been in this space for a long time, right? They've tried to get a bank charter in the past. They have offered a variety of different financial services products. They tried to spearhead MCX, the Merchant Exchange, which was an epic failure, the likes of which you really don't see that often in any industry. And, whenever Walmart gets involved in these things, the sort of mainstream press story is a combination of two things. One, Walmart has incredible reach and scale, as we know. So the sort of disruptive potential of Walmart is very large, similar to an Amazon or Apple or whoever else. And then also, and this is what drove them to do the merchant customer exchange and sort of try to circumvent the card networks, Walmart has always had a particularly sort of adversarial relationship with banks and with the card networks in particular, because they're a fairly low margin business at massive scale, and they really don't like paying credit card fees. They like to have more control over their sort of financial services destiny. So those are the sort of pillars upon which this Walmart is going to totally disrupt banking thesis continues to sort of rest on. And I do think the acquisitions they've made, the fact that Ribbit Capital has invested and sort of partnered with them, obviously all of the hires that they've made, including some of your old friends from Goldman, the fact that they're doing all of that tells me this is a fairly well-organized attempt. But I think, to your point, it's an attempt that we should look at as the latest in a long series of attempts by Walmart. And reading too much into, oh my God, this is going to be a hugely disruptive thing that's going to totally shake up the entire market, probably not, right? Like Walmart is still primarily a retailer, and that's their core business, and they're never going to invest that much outside of that core business. And, to your point about, is it going to disrupt the Chases and Bank of Americas of the world? Again, probably not, because even if, one by Walmart is incredibly successful, it's not going to be targeted at the same set of customers, right? Like, to me, this is much more a competitive threat for the Chimes of the world, the Varos of the world, the Money Lions of the world. I mean, like, that segment of consumers also tends to be very much a segment that shops at Walmart and that they have very strong relationships with. So I do think they can make some inroads there. I do think they can shake up certain parts of that market. But yeah, this sort of hysteria that burbles up anytime there's any reporting at all about, oh, Walmart might be getting ready to do this, or they just hired this person over here, I think it gets a little out of proportion relative to the actual disruptive threat.
Yeah, I mean, I think Walmart brings some very interesting assets to this. Specifically, obviously, its physical footprint, which I think is like 5,000-ish stores in the United States. It has a history of serving as a distribution point for Green Dot, as well as Bluebird, which at some point was like an Amex prepaid card. It also has its Walmart Plus, which is its Amazon Prime-like subscription. If you look at One's website today, I think it already messages, cash back when you use your debit card at Walmart. So you can see some of the pieces here. But I mean, I think, based on what we know now, I think your analysis is probably right that, it's not competing with a person who's using their Chase Sapphire Reserve or their Amex at Walmart. Is competing for the person who's using their Green Dot, their Chime, their Vero card at Walmart. And in that sense, I think it could be successful at capturing that customer. Now, does this become a meaningful line item to Walmart? Historically, their financial services plays haven't really been about generating revenue in and of themselves, but rather, letting a consumer cash a check so they can go spend the money in the store, or allowing a user to do remittance from the US to Mexico, where the person picking up that money will probably spend money in the store. So it's more of a corollary flywheel type thing and not necessarily intended to be a standalone, hugely profitable business. I'm skeptical that, this is going to be any different. It might work as get people to spend more money in Walmart, but the actual business unit at this point, with the examples we have, the Monzos and Chimes and Veros, I struggle to see how it's going to be a significant line item in the behemoth that is Walmart. I guess we can, leave it there if you want to tell me what you can't let go of this month.
Yeah. Let's end with the can't let goes. For me, it's crypto, as almost always is the case. And in particular, I was sort of casting about for the right one for our podcast today, and it was just announced this morning that the SEC has leveled a fine of about $1.3 million against Kim Kardashian for an advertisement that she did for a cryptocurrency. I believe she did it on Instagram. The cryptocurrency she was promoting was Ethereum Max, which is just as shitty a shitcoin as you might imagine based on that name. And, it's pretty interesting. She was paid $250,000 for this one post to promote it, which is obviously a lot of money. Although for Kim Kardashian, and given the number of different options she has for brand partners, it seems a little weird that she would do it for $250,000. And certainly paying a $1.3 million fine sort of washes out that. And it's really interesting. I went back and looked up the actual ad, and I'm just going to read the ad because I can't not. It says, "Are you guys into crypto?" 4 exclamation points. And then it says, "This is not financial advice, but sharing what my friends just told me about the Ethereum Max token. A few minutes ago, Ethereum Max burned 400 trillion tokens, literally 50% of their admin wallet, giving back to the entire Emax community." And then a whole set of hashtags at the bottom encouraging people to join the Emax community. And I got to say, obviously the CFPB, the SEC had a pretty strong case as to maybe this not being a good piece of investment advice that she was providing, even though she said it was not financial advice. But the thing that jumps out to me more than anything is a few minutes ago, Ethereum Max burned 400 trillion tokens. There is absolutely no way that her many followers have any idea what that means or why it's significant. And I'm just continually blown away by, in crypto, the worst parts of that ecosystem basically taking sort of technical jargon or complexity, like what does burning tokens mean? Is 400 trillion a lot? It seems like a lot. Taking that sort of complexity and packaging it into a way that sounds compelling and intriguing and like a good opportunity for consumers, when in fact, that doesn't mean anything and is in no way evidence of this being a good investment. And it just, strikes me as yet another example of sort of that core challenge with this ecosystem, which is when you assume that numbers always go up and to the right, and that I don't understand this market, but there are lots of other smart people who seem to know what this jargon means, that can make for a very dangerous combination. And I'm glad, honestly, that the SEC, even though it's been a while since Ethereum Max sort of burned itself out, is at least getting in here and saying, no, this type of behavior is unacceptable.
With that, my can't let it go. There was a very great episode of the New York Times Daily podcast recently about pandemic era fraud. In that episode, it mentioned how widespread and brazen various schemes were, that one individual in California actually made a rap video about defrauding the EDD, which is like the California department that handles unemployment, including in the video, like flashing envelopes of the prepaid cards that he received in the mail, which is how California disperses unemployment benefits. So, if you have an extra like 3 or so minutes, I think if you search for EDD rap video on YouTube, you'll probably find it. And it definitely, gave me a chuckle that it was that easy and people were that unafraid of being caught that there's a rap video about unemployment fraud.
Well, it's still up on YouTube?
Oh, yeah. No, I watched it like last week.
That is absolutely wild. Okay, well, we will leave it there. Jason, thank you so much as always, and thank you to all of our listeners. We will be back for a Special Money 2020 edition of FinTech Recap. And until then, thank you, sir.
Yes, can't wait. See you at Money 2020.
Thanks for listening to this episode of FinTech Takes. If you want to hear even more insights into the past, present, and future of FinTech, be sure to check out the FinTech Factor, the podcast series where I try to figure out how FinTech companies can build sustainable differentiation in this golden age of FinTech infrastructure.